The average American is paying $400 extra every single year, not because they did something wrong, but because they did nothing at all. $400 gone. Not to a better product, not to better service. Just gone straight into the pocket of a company that calculated down to the decimal exactly how much they could take before you'd finally get annoyed enough to leave. And most people never leave. Meet Dave. Dave is 38 years old. He's got a house, a car, 2 kids, and the same car insurance policy he signed up for back when he was still using a flip phone. 10 years. Same company. Never missed a payment. Never filed a major claim. Dave is by every definition the perfect customer. And that's exactly the problem. Because in the insurance industry, being the perfect customer doesn't earn you loyalty. It earns you a target on your back. Here's what Dave doesn't know. His insurance company ran his profile through an algorithm last year. They looked at his payment history, his zip code, his credit behavior, and one key data point, the fact that he hasn't shopped for a new quote in over a decade. And based on that data, the algorithm stamped his account with 3 words that are costing him thousands of dollars. Unlikely to switch. The moment that tag goes on your account, the price goes up. Not because your risk went up, not because claims in your area went up, but because the system knows you won't leave. And if you won't leave, why would they give you a deal? This isn't a conspiracy theory. This is called price optimization. And it's completely legal. But here's where it gets worse. And this is the part nobody tells you. Dave thinks he has loyalty. What he actually has is inertia. There's a difference. Loyalty means both sides are committed. Inertia means one side just stopped moving. And insurance companies don't reward loyalty. They exploit inertia. Every year Dave stays without shopping around. He gets quietly bumped up. Not by a dramatic amount. That would wake him up. Just enough to stay under his radar. Maybe $12 more a month, this renewal. $14 more the next. It feels like inflation. It feels normal. It is neither. It's a surcharge. A laziness tax. A we know you won't check fee. And it compounds. Let's do the math nobody does. Dave pays $180 a month for car insurance right now. 10 years ago, he was paying $130 for comparable coverage. His rate has climbed $50 per month over a decade. That's $600 more per year than what a new customer walking in the door with his exact same profile would be offered today. $600 a year. Over 10 years. That's $6,000. Dave has paid a $6,000 loyalty tax to a company that has a name for customers like him internally. And that name is not valued. It's inelastic. Now here's the part that'll really make your stomach drop. Dave didn't just lose the $6,000. He lost what that $6,000 could have become. If Dave had taken that money and put it into a basic index fund instead, at a conservative 7% annual return, that $6,000 would be sitting at over $8,000 today. Money that could have been working for Dave. Instead, it was working for the algorithm. And that's not even the real trap. The real trap is what keeps Dave from fixing it. Because here's the thing. Dave knows on some level that he's probably overpaying. He's heard the ads. 15 minutes could save you 15%. He's seen the billboards. But Dave doesn't switch. Why? 3 reasons. And all 3 of them are engineered. Reason 1. The hassle illusion. Dave believes switching insurance is complicated. He imagines paperwork, phone calls, coverage gaps, confusion. The insurance industry has spent decades making sure that's what you imagine. In reality, switching car insurance takes about 12 to 15 minutes online. That's it. But if Dave believes it's a 2-hour ordeal, he'll never start. Reason 2. The fear of the unknown. Dave has a relationship with his current company. He's called them before. He knows the app. There's comfort in familiarity, even when that familiarity is costing him money every single month. This is loss aversion in action. The brain doesn't compare what I'm paying now to what I could pay. It compares the comfort I have now to the risk of the unknown. And comfort wins, every time. Reason 3. The loyalty myth. Dave genuinely believes that 10 years of on-time payments should mean something. That loyalty should be rewarded. And that belief, that completely reasonable, completely human belief, is the most expensive thing Dave owns. Because the company doesn't share it. Not even a little. But here's where it gets worse. There's a second layer to this trap that most people completely miss. It's not just car insurance. The loyalty tax exists in home insurance. Internet providers. Cell phone plans. Cable. Credit cards. Anywhere that a company can lock in your billing information and count on your inertia, the loyalty tax is running, right now, probably on your account. A 2023 study found that long-term home insurance customers pay an average of 18% more than new customers for equivalent coverage. 18%. On a $1,500 annual premium, that's $270 a year. Every year, for doing nothing. The system is not designed to reward you for staying. It is designed to extract maximum value from the fact that you stayed. So what does Dave do? What do you do? Step 1. Set a 15-minute calendar reminder every 6 months, labeled insurance check. That's it. Not a full audit. Not a big project. 15 minutes. Go to a comparison site, NerdWallet, The Zebra, Insurify. Enter your info and see what new customers are being offered right now for your exact coverage. If the gap is more than 10%, you have leverage. Step 2. Use that quote as a weapon. Call your current provider. Tell them you just got a quote for X dollars a month for the same coverage. Ask them to match it. This works more often than you think, because keeping an existing customer is cheaper for them than acquiring a new one. They will negotiate, but only if you ask. Step 3. If they won't budge, leave. Seriously. The switching process is 12 minutes. The savings are real. And the message you send to yourself as much as the company is that your money is not on autopilot. You are paying attention. Dave paid a $6,000 loyalty tax because he never asked one question. Am I still getting a fair deal? The companies are asking that question about you. Every single renewal cycle. Their algorithm is reevaluating your account. They know exactly what you're worth to them. The question is whether you know what you're worth to yourself. The loyalty card they gave you felt like a reward. It was a leash. Don't be Dave. The average American overpays over $400 a year on insurance alone, not because they can't afford better, but because they never looked. Now you have. The question is, what are you going to do about it?